Welcome to Entrepreneurs, Executives, and Eccentrics, a podcast dedicated to the stories, strategies, and secrets of remarkable individuals. Join us as we engage in enlightening conversations with intriguing entrepreneurs, accomplished executives, and fascinating eccentrics, exploring their journeys, triumphs, and unconventional wisdom that has shaped their success. Get ready to meet Jeff Weller, CEO and co-founder of Lion Real Estate Group. He has led over 3 billion multifamily real estate acquisitions, transforming neglected properties into thriving communities. His work spans from Texas and the Southeast, earning the trust of top investors and family offices while delivering strong returns and lasting impact. Hello, Jeff. Tell me who you are and what you do.
Jeff Weller. I'm owner and one of the founders of Lion Real Estate Group. We invest in real estate across the country.
Okay, so let's dig in just a little bit. What type of real estate? It's multifamily, it's apartments. What type of real estate do you guys specialize
in? It's workforce housing, multifamily, and high growth cities. So we invest along the Southeast in Texas.
That's interesting. Okay, so what you do is is this your own money, or do you take investor money and then you go grab these apartments? I'm assuming this as an example, apartments, slap a coat of paint on it, make it a better place to live, rent it out, and raise it. Like, what's the process there?
That's exactly right. So we raise capital from family offices, institutions, and our own personal capital. We put it in. We buy properties that need facelifts, talking about interior renovations, exterior renovations, need better operations. We manage everything in-house, and we go do that process, improve the rents, refinance the properties with, bring back capital to our investors, and they get cash flow. If everything works correctly, they get strong cash flow for 5 to 7 years, and we sell it for profit.
Oh my God. Okay. Let's talk about this. Okay. So, first of all, how the hell did you get into this? But it sounds like a HTTV, like a high level flipping. It's a 7-year plan. You walk in, you're like, well, this is like 500 units, but it's a complete slum. I can go make this better. I can make it better, better for everybody. I can make it more valuable. How the heck did you get into this?
It's funny. So I was a commercial real estate broker out of college, and I was leasing office space to tenants, and I was doing some sales, and I had done pretty well on the sales side and getting commissions. And in 2007, I partnered with an investment banker who was from New York. And he said, I think you probably could raise some capital, and I know how to put together deals on the financial side. Let's go buy some apartments in LA. And we ended up buying a 7-unit apartment building in Santa Monica that was vacant, and the owner had passed away, and it was a sad story, in plane crash. And he had all these properties that he was halfway through renovations, and he did not, they were empty. So we bought this, we leased it to Google Housing, and I sourced the flooring. I sat outside with a clipboard trying to get the leases done. And it's a great business. So we found out that it was easy to raise capital for, because high net worth individuals get it, because they're usually entrepreneurs, and they get kind of the hard asset and the cash flow and the depreciation part of it. And then we were off and running. What happened in 08 and 09, you had the great financial crisis. We had no legacy issues, and we ended up raising a lot of capital through a couple of families in Beverly Hills. And we ended up, to date, we've bought $3 billion of real estate. We're raising our third fund, which is targeted $300 million. Our last fund was $225 million. And we just rinse and repeat. We buy properties that are 150 units to 300 units. It's really, to your point, no different than buying a fixer-upper house, going and buying a house in an area, and you say, hey, the rent's going to be $5,000 a month. I can buy it for X. Clean it up, put some stainless steel appliances in, clean up the floors, rent it, finance it, and keep it long-term. But we're doing it on a mass scale.
Yeah, it sounds like a lot of fun. To be honest with you,
yeah,
I know, but now you're able to take your eye, because it's a little bit of art, it's a little finance, right?
Yeah.
It's obviously, the kind of, it's you're creating something that's maybe less valuable than it should be. It's kind of what you're seeing, that delta. So I have so many questions. Okay, so how do you do this, right? Like, do you go look at like 20 properties a month, or are people bringing you deals at this point? How are you sourcing these deals?
So originally when we started, it was just my partner and I sitting in an office in Brentwood, California, driving around looking for deals and looking in the newspaper and just doing things, really rolling up our sleeves. It was very interesting. And then as the business grew, we hired acquisitions people. We have 200 people at our company now. So we have an acquisitions team, asset management team, property management company, and it just evolved. Every time we would close a deal, it was very funny. It sounds like nonsense, but we would do a PR, Lion Real Estate Group close the deal and put in, and people, you get referrals, and our capital base grew. And, in real estate, if you're buying through a recession, we bought a lot through 2009 to 2012. We sold close to 100 properties and generated close to a 30% net of fees IRR return with no losses. So we got pretty good at our little art of, and we've tried to stay. So we did pivot a little bit. We went and did not a ton. We did creative office repositionings in downtown LA because we thought it was fun. We were buying these warehouses for $100 and selling them for $100 a foot and selling them for $700 a foot. But as we did that, we sold them to big names that I can't kind of repeat. The reality is it's very risky. It's binary. If a tenant doesn't show up, you got a vacant office building in the Arts District in downtown LA. So what happens at that point? So what we then pivoted back to just saying, wow, what's the safest risk-adjusted return out there? You've got government-backed financing. You have a tenant base that's just growing with immigration and population growth. We're buying properties half of what they cost to build. So it's a very, if you do it right, to the ability to get year in, year out, mid-teens internal rate of returns and current cash flow and depreciation, everyone should have it in their portfolio somewhere.
I know, but it's okay. So I probably talked to maybe
people get nervous about. The illiquidity is what stops smaller investors from doing.
I talk to 8 to 12 entrepreneurs per week, right? Not necessarily on the podcast, maybe one or two per week on the podcast, but and typically it's I was doing this or I was flying planes for a living and this happens, right? It just feels like you literally fell into stealth. No one falls. I get that. But you are literally doing exactly what you're kind of made for, right? Because you saw and it's just that all the stars started to align. You're like, oh my Christ, there's a ton of money. Then I'm really good at this. And it's just a matter you start getting bigger. Like, how long have you been at this?
18 years. And I think the most important, it's a lot of fun. The last 2 years have been tough because interest rates went up 5 times, but we fixed in all of our financing with long-term financing. So we've performed better than our competitors, at least I think we have. I think the most important thing is I have a great partner who's my best friend. So I've got a partner who's my age, who has different skill set than what I have. He keeps me on my toes. I keep him on his toes. I've never seen a deal I don't want to do. He's never seen a deal he does want to do. So you have that friction and then you do good deals and it's fun. It's fun to come in and eat what you kill. You've got to, I've been on the phone this morning. I get up and now we're raising capital in the Middle East. I'm on the phone at 5 a.m. trying to, tell people our story. It's fun. And we've created great returns. So we do feel appreciated by our investors. We've had really good investors, really interesting investors who give us a lot of feedback that's helpful. Like I was at dinner last night with a consultant at McKinsey, and he was giving me great feedback on, hey, on your reporting, you should do this. Be careful of doing that. It's fun. It's very entrepreneurial.
Yeah, and it's just, I don't know. You're like, hey, I know how to do magic. Let's go do a lot of magic, right? And now it's like I get to go. And that's what. Because now you're not just relegated to like the execution side. Now you're kind of doing the entire, I guess, rainbow of the problem space, which is finance, which is long-term planning, which is investor relations, which is go find the damn projects, right? But it sounds like you've hired a ton of people and you've grown immensely as a result. So, okay, let's talk about that initial one, because, some of the people listening are going to hear, okay, well, you had someone who clearly understood how to make an investor package and go get this big is fine. What did that look like? How did that, obviously you're still doing your day to day, right? You're like, okay, I think we can let's go get $500,000 somehow. Let's go convince somebody that we can execute. How'd that work exactly?
So it's interesting. My business partner gave me the greatest ultimatum. It's like a wife. He said, you're not allowed to keep your day job as a commercial real estate broker. Either you're all in or all out. And I think when you do that, you don't have any safety below you or whatever you call it. You got to go in and you got to be really scrappy and gritty. So when you come in, you're like, okay, I got to track down every syndicator's package on how they're raising capital, what kind of terms they're giving, and what are the market terms. And then you've got to get a Rolodex, which I had a pretty good Rolodex of who do I think wants to invest in this stuff. And then I got to go find the deal and tie up the deal. So the running joke was I had a really nice car And my business partner was like, what the hell are you doing driving a $100,000 car? You came as a commercial real estate broker. It's like in '07. I said, listen, you got to look like you can afford the building when you come up to meet the guy. And there's little things to that actually, I mean, you will notice with every real estate guy, I mean, we own about 7,000 doors now. So we've owned 14 at the high point. Now we're down to 7. We're always cycling in, cycling out. And we're all kind of the same type of people. It's usually guys that are nervous Nellies, neurotic, weren't crazy about school, but understand how to make money and like hard assets. And you can deal with sleeping at night with taking liquidity risk, because the reality is you make a lot more money with not having liquidity, but not having liquidity is hard on a family. I mean, it's hard to run businesses like that, but it works. And so I think that it fit my personality really well. And, it's funny, a lot of guys get in the business, doesn't fit their personality. They make a lot of money and then they say, you know what, I want to go build a beautiful 20-story apartment building in downtown Miami with my name on it. And they go in because they want that ego of that building. I have no interest in that. My ego comes from performance and returns and being able to have really smart investors that want to keep coming back. And so that's kind of how, and my partner has the exact same outlook.
Let's go back to burning your ships at the shore of the New World. So I don't know what year. I want to say it's like 40 years before Christ was died. And Julius Caesar's at the shores of the Dover Cliffs, right?
Right.
And he's got his armada and he's ready to go invade. And he's got, they're freaking out because there's a line of very angry Saxons at the top there. And they're like, you know what, we can just come back another day. Let's just do that. So everybody pulls up and he sets all the ships on fire and they win the battle because there was no way to go back. Can you tell me about that mindset just for a moment? Because it is, I've done it myself. And I think the problem was I may have waited longer than I should have because I had a family. I have a family, all these things you worry about. You want to have all these things, right? But I may have been more successful quicker if I simply would have burned the ship from day one.
It's interesting. So in 2010, we were kind of at the market just kept going down, right? You would watch it and you would watch the credit markets and you're like, what in the world's going on? And at that point, I also quit drinking. I was a commercial real estate broker. I like to drink and have a good time. And I remember laying in bed and I go, this is going to go one way or the other. We are at such a bottom. I remember watching the stock market fall and everything. Either this thing's going to shoot up like crazy or it can't get any worse. So then you get into you go on the offense and you basically turn around and say, you have to buy your way out of this. And when you do that, good things happen. And as long as you're doing it, the number one thing in our business is investors. If you don't have investors and private investors, you don't have anything. They're your lifeblood. But when people kind of see that you pivot and take a position of getting aggressive, today is very similar to the great financial crisis. And so we just started buying and worked 24 hours a day. We would close a deal. We would take the brokers to Vegas. We'd come back, do another deal. I mean, we're doing 10 deals a year. And we really perfected the financing side of it. We got have a great relationship with Fannie Mae and Freddie Mac. We can get the books done quickly to get them financed. So, real estate is cyclical. It's a lot of timing, right? And then when the market peaked out in 21, 22, we had a fund, we deployed it and we bought good assets, but we fixed our financing. And so that gave us some time frame. We're making distributions and now we're raising our third fund and we're watching the market bottom out again. So now I just bought, next week, our team bought 3 deals from a lender. Lender foreclosed out a borrower. This guy had bought 30,000 apartment units across the Southeast. Some had been fixed, some had been floating. And so he's sitting there and he's like, I got to give some of these back. And we're buying them at 30 to 40% off what they were selling 1 to 2 years ago. Now, do you think that those are going to go down another? It's like gambling. In a sense, it's like, do you think they're going to go down? You got to look at the probabilities. No. And you're getting positive leverage. We were buying at a 7 cap. You're borrowing at a 4.5, 5 cap. You have positive leverage. Even if you can't get your rent growth or anything, you're still making mid-single digits to low double-digit cash on cash return. You're great. And so this is like when you hit the gas, right? And so we'll hit the gas for the next 2 years. We'll probably get back up to 12, 14,000 units. And then as 26, 27 come around and supply goes down, more institutions come in, we'll be selling and we'll sell through and we'll do it again. It's pretty intuitive, right? You just can't get too locked into a spreadsheet. You have to kind of sit back and look at probabilities and have a ability to sleep with risk. And that's a certain personality. And I sleep fine.
So that, well, and I'm sure your investors want to hear that as well, right? So so the thesis goes something like this. We will take a little bit of our money and a whole lot of investor money. We'll put a little bit of our own skin in the game. We'll go getting a lot of investor money, private office, family offices and such. We'll go buy distressed properties for 40 cents on the dollar because they're probably dog shit in some ways, right?
Yeah. Yeah.
We'll go make them beautiful again. We'll add the value back to it. We know there's a boom bust cycle of about every 7 years, right? Highs the highs, the lows the lows. We'll try to get in on the beginning.
But apartments handle that cycle much better than any apartments and industrial always handle them the best.
Let's talk about industrial for a moment. What do you mean by that? What are you investing in there?
Well, we're not investing in industrial, but whenever everyone's looking at jumping back in the market right now, they're looking at manufacturing, industrial, they're looking at multifamily. Industrial, you get those long-term leases. The returns aren't as sexy as our returns because we have multiple tenants and we're turning over with inflation, where people are pivoting out of office. I mean, which I think is crazy because I do think if you got some really big balls, you go into office right now and probably can find some pretty screaming deals, but that's not, our investors would never allow that. I mean, we just couldn't take the risk.
We've got a Belgian family member who also thinks that thesis is coming up, which is the commercial side of it, office side. And I'm like, okay, let's go look on LoopNet real quick. There's no bloody deals. I don't care. I mean, unless you're in Dallas, unless you're in kind of these strange things happening like a Denver or whatever, right? They're not, I don't think those deals that you find are public. I think it sounds like you're able to go find these things that aren't being really publicized much and actually able to value there.
And you have to be in the network of people and of knowing who's in the business and being able to get in their office and also being able to sell them that you can close. I mean, no one wants to get jerked around by a guy who says, hey, I can buy this $100 million property, and then you don't show up with a check. So you have to perform. And once you perform, you get a reputation of not being a pain in the butt at the closing table and getting it done. And I think my partner and I have done a good job on that. We will always leave a nickel on the table. Now, the other thing that we've done as we've made more money over the years, and I think our investors like it, we're one of the top 5 investors in everything we do, my partner and I. So what happened over the last 2 years is you had a lot of groups come in and syndicate deals, and they would take an acquisition fee. Let's say they're buying a $50 million property. They take $1 million acquisition fee. They invest $100,000 in the deal. They take $900 off the table.
And right.
Yeah. And so they're not aligned with you. And so what we continuously try to do at the cost of liquidity is continue to have our skin in the game and ride alongside our investors. So when we get hit or a building's not performing, I can go back and say, I get it. Maybe it's a 2% distribution this quarter, but I represent 20% of the deal with my partner. I mean, we're feeling it as well. So we're in the trenches with you. And luckily that doesn't happen that often, but when it does happen, it's a good thing. And people, when you have a good investor base, they understand that and they appreciate kind of that situation.
Can you describe the term sheet and just an average term sheet that you would, because ultimately I find it interesting that distribution, right? So it sounds like you're throwing up an S Corp, unless you're doing some crazy C Corp with 50 members or something like that.
Right.
Everybody has their perspective, investment, you're probably getting a bit of a vig on there because of you're managing it, right? Now,
Yep.
So you meet every quarter, you're like, okay, well, we did X amount of dollars. Well, let's go take our 6% distribution or whatever. Everybody gets their whatever. Everybody gets their K at the end of the year, and that's it. 7 years, you sell the asset and you're out. It's no different than it's just a corporation. There's nothing special about it other than it's just but the term sheet's interesting. What does that look like if you can talk about that?
Yeah, no. So on the fund, I won't talk about the funds because they're a different animal, but I'll talk about the syndication deals we've done in the past. So you would end up doing a syndication deal. Let's say you're raising $10 million. So your partner and I, my partner and I would put in, let's say $1 million. You got to get the $1 million. So this is after you've been in business a few years, you save some money, you have $1 million. You go raise $2 or $3 million. You're going to put debt on it. We would put a preferred return of somewhere between 5 or 7% So the first 5 or 7% of cash flow or money goes to that investor. And then above that return, we would take 30% of the profits, they take 70% of the profits, or we take 20% of the profits, they take 80% of the profits, and maybe there's a waterfall in there. What we do on top of that is we manage the property, so we charge a market fee. That is not a profitable business, but it's a business that controls your destiny, because you have people that work for you that you're bonusing out, and you say, listen, you're not a third-party manager, you work for us. So we've got to make sure this building is running at 95% occupancy. These units are turned efficiently, and you can call their cell phone. They pick it up because it's a company cell phone. You pay for it. It's not like I've got to go through a company to get a hold of someone. So that works well for us. Some people don't like it. We like it. And that's how you make money. You sometimes take a deal fee going in. What we did early on is we had bigger deal fees because we had no money. And we're like, listen, we got to get at least a few $100,000 to reinvest. Now we take very low deal fees because we want to be more aligned, and the money comes directly out of our pocket. And I think investors appreciate that.
Heck yeah, they do. Yeah, of course they do. Yeah, of
very
course. I know, but the fact that you're doing the managing, you can also call the soup and go, hey, let's get this 95. I will bonus the shit out of your year. Will be amazing if you make my year amazing. But if you have to go through some management company, you have no control over anything. They don't really care. They're still getting their fees for the most part, right?
That's exactly.
So that's interesting. To control the manage, you control your destiny. And
I met a guy the other day. This is amazing. It was the most brilliant story I ever heard. A really impressive guy. And he said, when we would hit our net operating income targets at the building, I would take a clearinghouse check of $5,000 and take it to the whole team and bring it down to them. I was like, that's amazing.
The giant 10-foot check. Yeah.
Yeah. And he put it on all his Instagrams and people loved it. It's a lot of money and everyone's doing their job,
Brilliant. Okay. So, is this forever for you? Or are you just 7 years, every 7 years, you're going to buy, you're going to make it better, investor buy a deal? Is there ever a deal at the end of the 7 years that you just keep the asset, or is that just your business model is we're out every 7 years?
So we have a legacy portfolio of about 3,000 apartment units that were syndications that we are always working on, continuously making cash flow. And then we went to the fund business in 2016, and those are shorter term 6-year funds. And so you're in and out. There's there's 3 parts of our business: property management operations, fund management, which is being a money manager. We never did joint ventures with someone who was managing the money. We always did it in-house because we wanted to have everything. We wanted the investor to talk to us and us talk to the superintendent. We didn't want the investor to talk to a guy in an ivory tower, to invest the money with us, to talk to the third-party manager. It felt like it was a daisy chain, and no one was it wasn't efficient, and people weren't making as much money as they should. Us as the general partner and the limited partner. So we create a business like that. We have long-term properties that we've owned for a long time, and then we have value add. I enjoy the value add because I enjoy going in, buying something for $100,000 an apartment unit, adding $10,000 an apartment unit, and then selling it for $175 an apartment unit and moving on, printing the return.
So, but it sounds like you have about 5 or 6 non-negotiables, whether you're aware of it or not. I bet you've got 5 or 10 of them. I'm just saying, what I mean by that, not aware of that is oh no, I never do that. I bet you've never written it down, right? And that sounds like one of the non-negotiables is no middle fucking people, right? I don't want to go from ivory tower to some middle manager, some fund manager, person to me, or better yet, have that ivory tower even have a direct line to the soup. It's a nightmare, right? So that sounds like a non-negotiable for you.
I feel like that all of our investors and partners today add some sort of value to us. I'll give you an example. We've got a CIO of a massive family office that sits on our board. The value add's amazing. I mean, he's been partnering with general partners forever. He understands, and he adds to every meeting we have. And we have another family office with 4 awesome guys, and they add because they've been investing family money for years. So they go, listen, Jeff, I want a multiple on my money. I don't care about the IRR, or I want my money back and I won't be working on the house's money, the debt side, or I think you're charging too much there. Why are you doing that? Or this, that, and the other. So every person adds value. It's not someone who's 24 years old at a ward and saying, hey, it works like this on a spreadsheet. Real estate is not a spreadsheet business. You have to go it's block by block, right? And so that works really well. we also do a really good job of hiring people and keeping people that are as gritty as we are, that want to do. My goal is for young guys that work with us, either they get rich with us or they say, I can do it better than you, and they go out on their own. And that was the right hire, and they're a good competitor, right? And so we've done that, and we've done that. I've done a good job, but we're not, listen, we're entrepreneurs and we're not managers. We're not the easiest people to work for. So if you can kind of survive our craziness and you're doing things the way we want, you're going to make a lot of money, or you're going to say, these guys are nuts and I'm going to go do it myself. And so that's, and it's fun. We want to have fun. And even in the last 2 years where rates went up 5 times, operations, we're still having a good time. And we're still looking at every property and how we can maximize value and how we're beating out our peers and also providing value to our investors. Because like I said earlier, when you have investors that are high net worth investors like we do, if you lose them money, you lose them $5, they never forget. They'll bother you to the end of time.
It's just, I don't know, it's just interesting because I think you're probably to a point in your life, in your career, where all the math is being done mentally, right? And I'm sure you're not casing apartment buildings anymore, right? But I imagine you're able to go, many cost me this, and you're able to do like back of a napkin mentally, right? You're able to go into a deal pretty quick.
You could show me a deal in Charlotte or Atlanta, and I can tell you in 5 minutes if it's going to work in our modeling or not. We just know what works. We know what doesn't. 150 units to 300 units, 1980s construction, half a replacement cost, going in at a 6 cap or better. You can improve the rents and you're borrowing in the high 4s. You've got an operator that was using a third-party manager. They're leaving some meat on the bone. They weren't behaving correctly on some things. That's your deal. And so dig into that one. The analysts and all the guys dig in. And it's kind of a science at this point. And then you look at what other people are making mistakes and you say, we do have some non-negotiables. At this point in our career, we're not doing new construction. We're not buying land. We're not doing office. We're not doing, we may have fun homes that we have, like our wives are dealing with. Great. But it is all about the portfolio of Class B apartments. And on top of all these things, you're actually doing something good for the community. You're actually providing a service. In Nashville, we own a couple thousand units around the airport. We have great tenants there. We're providing a clean, safe housing area. It's affordable, and we're doing the right thing by those people and hopefully creating some loyalty where they stay long-term.
Yeah, that's, it's, I don't know. It's just, it must be nice to be able to get to that point. Like, I've had, I've had several companies, but I've had 2 companies where I feel like I'm in the point in my career where I can see horse shit a mile away. I can see that, what's going to work, what's not going to work. I can smell what's wrong. And my non-negotiables are getting more granite now. They were a little flimsy 20 years ago or 10 years ago. And now non-negotiables are non-negotiables. They're just, sorry, but it's okay to walk away, right? So right. Some of those deals you walk away from are better than the ones you took, right?
Absolutely. The deals you walk away from, and it's a learning experience on, we've never lost money, and we will work things to the bone to make sure we come out and beat performance. But yeah, there's some deals that you said that you went into and you were like, well, that's not going to be a huge issue. And you learn the hard way. And maybe someone told you who's on your board, guys, there's lawsuit risk or the risks. Don't worry. Oh, the deal's so good. You don't know what you're talking about. You learn. And so we've learned some stuff that's very beneficial, but you're learning every day, and which makes it fun as well. And also on the money management side, you're learning every day. Raising capital is not for the faint of heart. It is. For every 100 people you meet with, maybe you get 5 bites, and then maybe you get a couple people that invest. You're continuously, because there's a lot of guys that do what I do. And there's a lot of guys, it's all about transparency, trust, performance, and they've got to like you. It's just a lot that goes into it.
Jeff, I could talk to you for another hour or two, but I will leave it here. Thank you very much for doing this. I'll add all the links to the bottom of this episode. Last question. If you were giving advice to someone in your 30s, right, who maybe understands the P&L, understands the balance sheet, has the basics down, how would you advise them to start?
Just go buy the house next door. Go wherever you're living. Go buy a little. This is what we did. Go buy. Don't forget about the economy. Go dig into your newspaper. Find that duplex. Find that 1 unit deal. Dig in and figure it out. create a brand of who you are and how you perform, be very transparent. Don't be a jackass. Like, you be a professional and do that. And it grows quickly. It's a scalable business. And if you're good, people will find you. If you're a crook and people may find you, but you're going to be out of business pretty quickly. It's all about transparency, trust, and just getting started. I think the biggest thing I've seen is people make a lot of money in their day job. So they're sitting there and they go, I want to leave my day job. I'm making 6 figures. But forget about the money. Where are you going to have more fun? And so then if you're having more fun, my partner and I, this is great. First 3 years, we made no money. And I remember laying on the couch in his office, like we were just grinding. And I said, Maury, this is going to be a lot of fun if we ever make money. And, things, like this is going to like, we're having fun, but this is going to be a lot of fun.
Right.
And so,
yeah, when I can pay my bills, this is going to suck a lot less.
Yeah. Right. It was like fun. You're doing something. It's fun. So I think and get a good partner. You have to have someone. If you do it by yourself, it's very hard. You work in a vacuum. No one calls you out. And before you know it, you think you're smart. Every real estate guy thinks they're smarter. A lot of it's cyclical. A lot of it's timing. You got to have someone who keeps you in check.
Jeff, thank you for doing this.
I appreciate it. Thanks, Scott.